Hi ladies and gents, I'm Evan Andreo from Old Mutual Wealth. You might not be able to tell by my youthful exterior, but I've been doing investment management for the last 30 years. And my own retirement is starting to become a very real thing in my world. I asked myself the question, what's my biggest enemy? What's the biggest problem that I'm going to have to face? And after some exhaustive research, the conclusion is that I am my own worst enemy. And what I'm referring to here is how long I'm going to live. Now, if I were to have retired in the 1800s at age 65, I would have been dead 27 years already. In 1900, if I had to retire, I would have been dead 12 years. In the year 2000, I would have probably still had about 15 years to go. And if I were to retire in 2100, I might only be halfway through my life. So my own longevity is a problem, and that is going to lead to inflation being my biggest enemy. And that made me ask myself, what should I be careful of as a person about to enter retirement? And there's a certain logic. I'm retiring, I'm going to draw income. So ideally, I should be investing in assets that provide me with income. Sounds fantastic and works really, really well if those assets grow and the income grows. Doesn't work quite as well if the capital doesn't appreciate and the income depreciates over time, because the longer I live, the more inflation plays a role, the less purchasing power my money will have. And that sort of income investing idea is something that I've been playing around with. Should I be putting money into money market and living off the interest? Should I be investing in bonds, living off the coupon payments? That is a question that comes up very often. And quite frankly, ladies and gentlemen, I haven't saved enough. If I had to look at the Johannesburg Stock Exchange and just live off the dividends, well, as at the middle of this year, June 2021, the dividend yield of the all-share index was 2.5%. Now, working on the assumption that I'm probably going to be needing to draw somewhere between 5 and 6% of my capital as income, the dividends are only going to give me about half of what I need. So I need to consider an investment strategy that's going to give me access to both capital growth as well as income generation over time. So what shouldn't I do? Because I've got a lot of ideas about what's clever. What are the things I should avoid as someone nearing retirement? Quite frankly, the first thing is I shouldn't be taking down the risk of my portfolio. We often have this sort of concept of life staging where clients become more and more conservative as they near retirement age. They then reach retirement age and very often have to swing the pendulum back to the other side. So ideally, I should be maintaining a fairly neutral position when it comes to risk. I should also be very careful of having my money in cash and then waiting for that ideal opportunity. In the last 20, 30 years, so often I've heard this, we just want to wait for the market to start running. Who the heck knows when the market's going to start running? So trying to time that market is particularly dangerous. Even worse when we start talking about offshore investing and we suddenly want to start timing the rand as well. It becomes a really, really complicated exercise and something that I believe we should avoid at all costs. When we consider the costs of investments, I think it's important I need to try and manage the costs. It doesn't mean necessarily going for the cheapest, but I also don't want unnecessary surprises from a cost perspective. I'm also hesitant to invest in themes. Over the last 18 months, we've really seen this sort of blowout in tech-enabled stocks. The likes of the Amazons, the Netflixes of the world have really done particularly well. Should I be investing my retirement money there? Is that a theme that's going to continue for the next 10, 20, 30 years that I might live? I need to be careful. So what about the risks then? What are the risks? One of the clearest ones is that I'm going to live too long. I'm going to have more life than money. Inflation is going to hurt me. It's almost inevitable I'm going to be in the market at the wrong time and out of the market at the wrong time. So trying to time these things becomes really tricky. I need to be careful of investing, for argument's sake, in a money market, being too conservative, trying to live off that interest, and in all likelihood, it's not going to be enough to support my lifestyle. So I'm going to need to embrace a bit more risk in a portfolio post-retirement. That brings about a whole bunch of complications. And one of the premier ones is something that we call sequence risk. And that is, when markets go up and down and I'm drawing money out of that investment, if the market should be on a downturn at the time that I'm drawing, it's just going to compound the losses. So I need to find a way of managing that. And then I need to protect myself against myself. We as humans we have two base emotions, greed and fear. When things are going well in markets, we think they're going to go well forever. And I'm happy to pile boots and all and buy every single share on the stock exchange. When things are going badly, I think it's never going to go well again. And I will do everything in my power to get out. So those two things, I need to protect myself against that, strip the emotion out of the investment. How would I build something that is actually going to stand up to all these risks? I think firstly, it's very important that I provide the full financial picture to my financial advisor. They're going to need to know every little thing about me. I can't hide anything. Very importantly, instead of wondering whether I'm a conservative investor or a moderate investor or an aggressive investor, let's rather focus on the income that I need. Draw up a proper budget. Understand how much income I need, what percentage that will be as a monthly withdrawal from my capital, and let that rather inform where my investments are placed. Try and manage the volatility over time. It's going to be critical. One of the ways that I like to think we're able to do that and stay invested in the market is by making use of something that provides some sort of smoothing, a smooth bonus type of portfolio, link that to a market-linked portfolio, and it gives us the best of both worlds. So obviously we need to look at a strategy that allows us to manage volatility as well as participate in market growth when it happens. In summary, 3 points. Firstly, let's make sure that we try and smooth out this post-retirement journey as far as possible. It will enable us to have more consistent returns over time. It's very important to stay the course. Stay invested. Don't try and go in and out of the markets. Don't try and time things. And I think the last and final most important point is make sure that whichever portfolio we're invested in is diversified across various geographies, across various asset classes, and it gives us the benefits from being able to capture growth from various sources. Thank you very much.